Happy Friday, everyone, and welcome back to Your Finance TV. As you know, Fridays we have Jay Pelosky from TPW Advisory. How are you, Jay?
Happy Friday, Scott. Nice day outside. I think we should be trying to figure out how to do this outdoors.
Yeah, listen. I'm very jealous of all the people out there playing golf today and so forth. But we're stuck here. We've got some great information coming from you. Before we jump into the show, I want to tell all the viewers: don't forget to click on the subscribe button below. Viewers are growing every week, so thank you very much for that. Now, your musings this week is titled "Into Price." Now, I didn't really have anything to go with on that side of it. Like maybe I was thinking like the price is right. That's where I was going with it. But run me through its into price.
Well, it's more about the old market adage, right? Let the market tell us what's going on rather than we try to tell the market, right? Because the market is supposed to be kind of all-knowing, forward-looking, discounting machine, right? Taking all the inputs. And so everything kind of should be in the price. And of course, that doesn't mean the market's always right and it can't get new information and change its view. But it struck me really in looking at the regional bank index yesterday, using KRE, the ETF, as a proxy for regional banks, and stems from my opportunity yesterday morning at the Open to be on the Bloomberg TV show, The Open, and all the pre kind of open chatter, because my hit came on at like 9:35 with Lisa Abramowitz, and all the pre-open chatter was about Pacific West Regional Bank, which was down 25%, and this is another example of a rolling bank issue, and what about systemic risk, and what about credit crunch, and all the rest of it. And so, I was asked, of course, the first thing that Lisa asked me is, well, what do you think about the regional banks? And I'm like, I really don't see it as a huge concern. And remember, we wrote Firebreak right around the beginning of when Silicon Valley Bank went under mid-March, now 2 months ago. So that's important to remember. This has been going on for several months. But Firebreak was the thesis that this is actually a good thing for the overall economy because it's going to stop the Fed from over tightening to such an extent that it would damage the real economy, as opposed to kind of the early trigger tech and finance side of things. And I think that's kind of played out reasonably well. And then the other issues that we've paid attention to, we look at, for example, high yield spreads over Fed funds. And that's right about 200 basis points, hasn't really moved much, and is very low relative to past systemic crises when it typically pops to 400 or 500 basis points. A couple of other indicators that we're paying attention to that all suggest we shouldn't be worried about a regional bank issue morphing into something more severe. XLF, which is the big bank ETF, there's a really important support line around $30 to $31 there, continues to trade well above that. The VIX index, stock volatility at 16, no sign of real concern there. The MOVE index, the US Treasury volatility index, no sign of concern there, right about 125. So really it was like basically, we're not all that concerned. And then to conclude the story, at the end of yesterday, so at yesterday's close, I reminded myself to look at KRE, and it was down about 2.5%, closed right about where it had opened. And importantly, the tell was in the volume. So trading volume on KRE yesterday was 40% or so below the 10-day average. And so that suggests to me that the selling pressure is pretty much exhausted, right? And then I went back and looked at the performance of KRE over the last couple of months. And surprise, it's up 5% off the 52-week low, which it hit a couple of weeks ago. And then I went and looked at the S&P, because if this is a big issue, obviously it should affect the big market and the S&P 500. And lo and behold, the S&P is actually up 2% since the Friday before Silicon Valley Bank went under, which was, I think, March 4th or 5th or something like that. So the S&P, through all this regional bank crisis and multiple bank failures, is up. And so that tells me that it's into price.
Okay.
Somewhat long-winded, but hopefully you got it.
Okay. Now, one of the things you've talked about quite a lot is treading the middle path. Now, I think it's a good time to go back and have a look at this middle path again for the viewers.
Sure. And the middle path is something, as you point out, we've been talking about for about a year. And it's basically our view that there's a middle way through the two risks of high and sustained inflation and deep recession. And we're arguing and have been arguing that there is a middle path, or what some dismiss as a soft landing. We think that is, in fact, viable. And we continue to think it's playing out. When you look at inflation coming down quite considerably, we note that inflation in the U.S. peaked roughly a year ago at 9% plus in June of 22. We're now at 4 to 5%. We think the next several months are going to be very benign for inflation because the year ago levels were roughly 1% in May of 22, in June of 22. So we're actually expecting, and not only us, but the Cleveland Fed is projecting for inflation to be about 4.1% when the Fed meets next in mid-June. So we think inflation is continuing to come down, and we think we're early cycle in an economic recovery, not late cycle going into recession. And we're looking at things like housing, we're looking at inventory destocking, which were the two big drags on the economy last year. Housing is clearly bottom. The best performing instrument we had in our global multi-asset model over the last month or so was XHB, which is the housing ETF. The second best was IYT, which is transports. So again, we think the market is telling us, with the early cycle things like housing and transports doing well on a relative basis, that we are in fact early cycle because those things are starting to work. And so the market, forward-looking, discounting, is looking ahead and doesn't see recession. It sees economic recovery. So our view is that we expect to see the inventory destocking of the last couple of quarters lead to inventory restocking in the next couple, which will lead to the ISM manufacturing index going above 50. Barclays, for example, expects it to be at 53 by the end of the year. Right now it's 46, 47. Been trading around 46, 47 or moving around 46, 47 for 4 months. Remember, the dividing line is 50. Above 50 indicates expansion, below 50 contraction. So we're looking for that information to be supportive of our middle path and a view of an economic recovery led by housing, which is clearly bottomed. Housing stocks making all-time highs. The job market, which is easing and cooling, but not collapsing. And then the manufacturing segment of the economy starting to recover as you have that restocking underway, particularly in the autos. Again, in April, just last month, the best year for auto sales in over a year, 16 million units at an annualized rate. We need to restock the auto sector. So that's going to help drive the economy. And as we move into June, we expect the Fed to not only pause and not raise rates, but also update their economic forecasts, which they do every June, to higher growth than they have currently penciled in, which is only 0.4% for the full year of 2023. So we think that is going to kind of validate the middle path and validate our view of the markets.
Okay, well, we had a great episode last week, and if you haven't seen it, make sure you go back and look at it. It was Jay doing his monthly breakdown. We know you updated your models, but what are you going to be paying attention to going ahead, especially considering next Monday night, I think it's 10 p.m. Eastern Standard Time, you have Chinese retail data, and industrial production as well?
Well, it's a great question and very similar again to the one we kind of ended with Bloomberg yesterday, which is like, okay, you're positive, you expect markets to break up and out, which we do. What would give you pause? And we replied to that with saying, obviously, we watch earnings. Earnings are what drive stock prices, and we continue to look at earnings as well as the estimates for earnings in corporate guidance. Corporate guidance is also projecting higher earnings as we go forward. So that's kind of on the U.S. front. We think that earnings have troughed, that the analysts are going to be proven correct in forecasting higher earnings as we go through the second half of the year. Corporate guidance suggests the same. There's really a tension between the fixed income marketplace, which is priced for recession, right, with rate cuts in the second half, and the equity analysts who are forecasting rising earnings in the second half. And only one of those is going to be right. And we think it's going to be the equity analysts, and that's going to be validated once the Fed says, hey, look, we think growth is going to be stronger. That we think will lead people to pay attention to the earnings estimates. And that's one of the things that's going to help the U.S. market at least start to move higher and break out of this long trading range. On China, China's been a real conundrum, right? Because the growth has been strong. Most banks are raising their GDP forecast to 6% or more. The Caxton composite PMI for April just came out. It's at 57, very strong. And yet the stocks have been pretty mediocre, right? With the main ETF, FXI, down 2% year to date versus the ACWI up about 9%. And in particular, tech, KWEB, which is something we've held, is down 12% or so versus the NASDAQ breaking out to a new bull market. And we do think that NASDAQ breakout is important because it's signaling that AI is kicking off a new innovation cycle. And the big cap tech stocks are really the only ones who can play it because it takes so much money to really get in the AI game, right? And so you have two things happening. You have AI kicking off a new cycle, benefiting the big cap tech stocks, and you have the Fed on hold, reducing the concern that people such as ourselves have had about rising rates being negative for big cap growth stocks and big cap tech. And you had the correction last year. So interestingly, we do think that NASDAQ is leading the new bull market in the US, and KWEB is not following, right? So that's a concern. And we're really digging into that China and that discrepancy quite a bit. We've had a good call on being overweight non-US equity, right? EFA is the best region, Japan breaking out, Europe already broken out. Europe's up 30% over the last year versus US up 6%. Mexico's breaking out. So there's a number of markets that are breaking up and out, and we've been participating in them, which is great. China, sadly for us, because we do have exposure there, is not one of them. And so we're paying close attention to that. But our view is that the S&P is going to break up and out. The Fed is going to clearly pause in June. They're going to upgrade their growth estimate. That's going to have folks understand that equity analysts are right to be saying earnings are going to pick up in the second half. Bond analysts are going to be wrong in calling for rate cuts. And that's going to be the opportunity set as we move forward into the second half of the year. Early cycle, global economic recovery, earnings recovery, not late cycle, recession, earnings downgrades, lower stock prices.
What? Okay, you've always been bullish. No, I shouldn't say always been bullish, but you've been positive thinking, which is, listen, I love that. What?
Quite rare these days.
But where is it something that could change this? Like, it's like these scenarios don't come together. Like let's just like speculate. Let's say it is China invading Taiwan. Like, and obviously that's a very big extreme and so forth. But what is something that could change your outlook on this?
Well, I mean, clearly, if earnings estimates turn down, I mean, it's kind of like we talked about on Bloomberg yesterday, right? If earnings estimates were to all of a sudden really turn down aggressively, if corporate guidance was really saying, "Hey, we really don't see much visibility next year. We're taking down our expectations for growth and sales growth and profit growth," those would be the main factors because that's what really drives stocks, right? It's not GDP growth; it's earnings growth. And earnings are inflecting upwards. Better, and I'm not just talking about Q1 being better than expected, which has clearly happened, but that's behind us. I'm talking about analysts listening to those Q1 calls, quizzing companies on their outlook for the rest of the year, and going back and raising their earnings estimates, and companies giving forward guidance and higher forward guidance as they go forward. And so if those were to change, that would be a big deal. If XLF were to break below that 30 level, right? I mean, we're in a trading market, a trading range, a long trading range. We're due to break out of this trading range. And so, we're watching levels. And so XLF, given the bank stuff, is a very important level. I guess if we have a true default by the U.S. government, and it lasts for a considerable period of time, that's going to be a big change. Again, markets are not suggesting any real concern about that. I write in the Musings today that I think if there is a pullback on default fears, it's probably your last best buying opportunity because it's not going to last for long. It can't. And therefore, buying then and assuming that the economic recovery continues, you're going to be fine. So there always are things out there, right, Scott? I mean, our business is a business of weighing probabilities. It's a business of trying to forecast the near future. It's a business of trying to decide what's the right price and how much risk am I going to take. And, we have been positive. And for all the media play of bearishness and credit crunch and bank failure, let's remember that all global equities are up double digits year to date, double digits. Let's remember that high yield is up for the year. Let's remember that Europe and Japan are breaking out. Mexico is breaking out. There's a lot of opportunity around the world. And so I think we're in what we've been calling the curtain of FUD, right? Fear, uncertainty, and doubt. And every time you think it's like it can't get any thicker, they pump it up with something new. It was the regional bank failure, right? First it was COVID, then it was inflation, then it was the Fed over tightening. Now it's regional bank failure. Now it's debt ceiling. It just keeps going and going and going. But it's obscuring what we see are multiple positive changes. Central banks accepting a slightly higher inflation rate. We think 3, not 2. Industrial policy in the U.S., first time in 70 years. End of yield curve control in Japan. China going to domestic demand-driven growth. These are all big, powerful, positive policy changes that are being obscured by the curtain of FUD. And we're waiting for that catalyst to remove the curtain of FUD and reveal the fact that we're not going in a recession. We're in an early cycle global economic recovery. And by the way, everybody and their brother is thinking we're in recession. So as I said, bonds are priced for recession. Stocks are positioned for recession, right? Big cash, horrible sentiment, et cetera, et cetera. As that moves away and people realize that's not going to happen, that's when we think the equity opportunity is really going to become visible to people. And all that cash, which, by the way, is one of the worst performing assets year to date, is cash. It's up about 1%, less than 2%. Acqui up 11%. So all that cash is going to then come back into the market, and that's what's going to help us go higher.
It's funny. You use that word FUD a lot lately, which that always makes me chuckle. But I actually did a little bit of research on FUD, and there's a sausage company called FUD. All sorts of different flavors of FUD.
I might have to get some of that and see if I can maybe get a sponsorship.
All right, Jay, listen, thank you so much. You enjoy your weekend. Happy Mother's Day to everyone out there as well. And we'll be talking to you again next week.
All right, same to you, Scott. Thank you.
And for everyone else out there, good luck investing.